Okay, good morning. I'm still thinking that it's morning time, but it seems like we had a very good panel discussions, and I would like to um, introduce our wonderful panelists today. This is Leslie, Tsao family office in Singapore, and this is InYeong from Mitsui, Bussan, Pana, Harrison. And this is Stefan from ILS Advisors, HSZ Group. This session is perhaps that, we would like to actually step back a little bit, that ILS is, from the end investor's point of view, it is still a smaller allocation within the end investor's portfolio. And I never seen that investors allocating more than 10%. I think in average that the panelist already mentioned that it's about 5%, maybe between 0 to 5. So something like we would like to be mindful about, what are the, investors' remaining portfolio reacting in this current capital market environment. Of course, 2023 was a wonderful year for ILS, in terms of performance. And also 2024 is a great year for the inflows into ILS, especially carbon space. But then we would like to predict how the new money inflows coming into this space. But as I said, ILS is still in a relatively small allocation within the end investor's portfolio. So we would like to hear from the professional who is in this space and also in the fixed income contents, how that they have been looking at ILS. But before that, I would like to actually sort of say that last 5 years or so, most of the end investors started investing into private assets. And the private assets means that private debt, direct lending, private equities, something that the illiquid nature of fixed income assets, more so the ILS. And that was a great demand in the private assets. Having said that, we have experienced a huge rate increase in, central bank in US, Europe, Asia, and there's also inflation concerns, and there are also geopolitical concerns, and these are kind of concerns are, obviously embedded within the private assets and also fixed income assets. So we would like to figure out, what was the remaining 90% of the fixed income portfolios, embedded risk has been, and something like I would like to hear from Leslie that with your fixed income portfolio, what kind of risk is the main risk that you're facing, and what is the potential mitigation that you could actually hedge against the future volatility from the capital market, and how would ILS play within that context?
Sure. Good morning, everyone. My name is Leslie Lim. I work for a single-family office based in Singapore. And within the family office, I manage a number of portfolios, our fixed income, our private credit, and what we call liquid alternatives, which is hedge funds of another name. In terms of thinking about the opportunity set in investing, I think ILS is one segment which we've included currently within our fixed income portfolio, but you could make an argument that it could belong in either the private credit if it's part of the more illiquid type of version of ILS, or potentially with the other hedge funds type strategies. I think about the opportunity set today, and maybe take it back a few years prior to COVID, I would say that was a challenging environment to invest in, where rates were low, credit spreads were very tight. So if you were investing in traditional fixed income bonds, it was basically an accident waiting to happen with rates going up, and if things go wrong, your credit spreads widen. So it was a very tough time to be in liquid fixed income instruments. So in that environment, we would have favored doing more in the private credit space, where you get paid at least the illiquidity premium. And I think you could make the argument that ILS has many characteristics that would put it into the private credit bucket. Having said so, conditions have certainly changed with COVID. And I think the most dramatic one is the sharp rise in the risk-free rate in the U.S. And many parts of the world, where in the past, rates were giving you essentially nothing. Now you get 5%, which is a princely sum if you think about it from a few years back. So as we look at the environment today, things are quite interesting. I would say that credit spreads, which is a thing that I'm very focused on, has post-COVID initially got very attractive, and over time it's compressed back to pre-COVID levels, to the extent that when you look at it now, it's credit spreads now versus pre-COVID, it's essentially unchanged. But if you think about the operating environment today, it's not unchanged. Things are quite challenging. While we still see that the growth, particularly in the U.S., is very strong, there are certain issues coming up under the surface with the consumer, particularly lower-end consumer. We're seeing credit card delinquencies go up, subprime auto delinquencies rise to record levels that have only been seen in the past recession times. So I think there's some trouble coming true. And in addition to that, if you think about the rate, the impact that the rate increases have on operating businesses, if you were a business that was levered 6 times, built on a business model where rates were essentially zero, now that rates are 5%, it's going to be very challenging. So this is not to say that we're sure that it's going to be a recession, but certainly where credit spreads are trading today feels way too tight. So in that context, I would say that we like where the rates are, but we're cautious on spreads. So where do we invest in? We started looking at ILS about a year ago, and in earnest about a year ago. Previously we had tracked it, but I think the difficulty for us has always been the fact that it's a very complicated it's a very complicated area where there's a lot of different terms, things that as a financial investor you don't really spend much time on, attachment point, losses, perils. These are things that are not part of my day-to-day lingo. So the threshold, the learning curve was very steep. But when we looked at it a year ago, what impressed us was the fact that there was you're paid a big excess spread versus where losses were, much more than it was historically. And this location is something that we constantly focus on. As a family office, I think one of our advantages is that we can use our size and our nimbleness to move in and out of things as and when they become attractive. And ILS, in particular cat bonds, became very interesting.
It's a very relative value play, isn't it? So,
Absolutely.
as you said, that investment grade credit or structured credit, ABS, or private asset in general has been tightened, and whereas ILS in particular is probably the outlier in a good way. That it's quite strong beta.
Yes. So there were two things that were interesting about ILS. One was the excess spread, but the other is the diversification benefit. When I construct a portfolio for investment, one of the things that I'm very focused on is making sure that the individual investments do not move in the same way as far as possible. So we want things that are either lowly correlated or negatively correlated if possible. And I think ILS is something that It's not uncorrelated, but by and large, we feel pretty good about the correlation versus the rest of our portfolio. So that was very attractive for us.
So as Leslie said that, although ILS is quite attractive, but you can't really put 100% of your time into, ILS investment analysis. So something that you would like to perhaps refer to ILS managers or professional to actually look after the portfolio. So that's how you would expect from ILS managers?
Absolutely. I think we're on a learning journey with ILS. It's early days for us, and I think we spent a lot of time trying to understand the different terms, the different features, players, but I think the recognition is that it's a very much a specialist market. It's very different from everything else, which is one of the attractions, but will I ever get to the point where I'm comfortable investing in single cat bonds or individual ILS structures? I'm not sure. I'd say it's a work in progress. We're probably many years away from that. But I think cat bonds was an easy way to get into the space, and in particular finding managers that have the experience, expertise, such that it's not an issue for us to think about pricing and whether we're going to be the dumb money in the room.
Well, I'd like to hear more about later on how was your onboarding process was like. And but before that, I would like to ask Stefan. You're the first Asian-based ILS managers, and I would like to hear from you that what's the skill and role of ILS managers for investor like Leslie?
Well, as Leslie said, it's a complicated asset class to begin with, and I think the role of the ILS manager here, the first one, especially I think here in Asia where the experience is not so developed yet, is really education, is investor education to make sure the investors understand the asset class, and I catch myself often in meetings we had this week, using lingo that is very common to what we talk about every day, but maybe not so common with the average educated investor. And I think there is a lot of work to be done to make sure the investors fully understand what they get themselves into before they do that. I think that's an important part. And also I think is important to put in front the quality of the asset class, the diversification that has been talked about a lot, which cannot be overemphasized. But I'd always caution about talking about too much about the performance, because you live by this word and you die by this word when you sell the asset class only with performance. If as we know, we have cycles. If that's not the case, then obviously then you lose your best argument. And I think that's another important point I would say in terms of what's the role of the asset manager. And then another important role, I guess, of course, is to, as Leslie also said, to provide efficient and access for the investors to the right instruments. And of course, it's different whether you have U.S. investors or Singaporean investors. So we have to find obviously the right structure, from a legal and tax and whatever considerations there are, and to make sure you, as always when you advise clients, is about to understand their return expectations, of course, but equally important, you have to understand their risk appetite and risk tolerance, and not to forget the liquidity, right, which is, as we have experienced in 17-18, is an important criteria. So to make sure you don't put a novice investor, first time invest in the ILS space into some private fund that has no liquidity, and there's a lot of risk of maybe if events happen that there's trapped collateral. So it's really important to make sure from the start that this is very clear to the investors. I think that's where I see the important role. Besides, of course, our then goes more into the skill, of course, and to really deliver on that promise, right? To be able to deliver to the investor what he has been expecting. And I think, as has been said as well today, is also, and where we see our role as being a manager based out here in Asia, is to provide investors also access to diversification. As was mentioned many times already, that most managers are very heavily geared, of course, given the asset class, to US risk. And what we try to do is to find diversification for investors, but accretive diversification, not meaning diversification for the sake of diversification, but making sure that the investor still gets a decent return. I think that's where the skill part comes in, I think, in our role as the ILS manager.
Thank you. Well, the previous the panel discussion in this morning talking about the lag of pricing and as well as when they started originating the issue and actually sort of time of launching. In terms of our side of the universe, that lag between the catastrophe event happening versus actual loss disclosure is something that we tend to struggle, I must say. How do you deal with the lag between the event versus actual disclosure?
Yeah, I think we saw that with Hurricane Ian, right? Where obviously most recently in 2022, when obviously most people thought there was major losses, and then luckily at the end of the day, it turned out to not to be a loss actually at least for the cat bond investments, and so yeah, I think that's difficult to manage, but I think it's also important to manage investors' expectations. No investor should go into the asset class just praying every day nothing happens. That's the wrong way, right? Investors have to be aware there will be events and there will be losses, but that's also our role, I think, to prepare them and show them, look, yes, there was 17, 18, there was Tohoku, there was Christchurch, so to show the investors, how a bad year could look like, not just show them the good years, right? And so I think that's really important to make that at the beginning very clear, that so that they understand also the downside that there is, of course, besides all the positives that are, of course, more important, but I think that's very important. Otherwise, and also think that's another point, maybe to mention is, in my experiences, it's better to stay disciplined in soft markets. Many, if you chase the returns, then your risk profile will change, and maybe the investor is not fully aware of that. And so it's more important, I guess, to explain to investors, okay, that's the risk you can take, that's your risk appetite, your risk tolerance, but then the return you get is a function of the risk that the investor can take. And that happened, I've experienced that ourselves in 2016, investors coming in late, and they wanted the highest returns, and obviously the risk at that time, because it was such a soft market, were quite high in order to get double-digit returns. And these investors then came into 17, 18, and it was a huge disappointment. I think in order to avoid that, one really has to be upfront and clear to the investors, how also a bad year could look like.
Yeah, you're right. You know that you have been Mitsui & Co. And Mitsui & Co. is a direct asset owner of insurance, and basically from their point of view, the risk tolerance has a certain level, but they also have quite open book in a sense that the way to put their money into. So what do you think that what makes ILS more attractive to your entity, like the direct asset owner point of view?
Thanks, Yuko, for a great question. Good morning, everyone. My name is InYeong. I'm working for Mitsui & Co. in-house reinsurance broking company. So Mitsui & Co. is one of the largest trading house in Japan. They did contribute a lot for like a world economy and development of less developed country, infrastructure development, and renewable energy. So before, when I was working as a treaty broker, I was working with a lot with ILS, especially with collateralized reinsurance. But at the time, I was busy with just securing additional capacity just on top of traditional reinsurance capacity to provide like a good risk management strategy for the insurer. But after joining Mitsui & Co. company, I understood Mitsui & Co. is one of the biggest, can be one of the biggest investor for ILS. But at the same time, the Mitsui & Co. is actually origin of the risk, because Mitsui & Co. did a lot of investment infrastructure like a highway, airport, and wind farm, solar, all these kind of things. In the end, this is making our world better. But with a single investment, we definitely need risk management strategy. So previously, the Mitsui & Co. was very keen on a direct and indirect investment, like let's say one of the insurance company and one of the Lloyd's syndicate. And then after passing some the market changes, and then after suffering some kind of big net cat event, and then now more keen on indirect investment into the ILS market. But at the same time, what I have learned during my the limited time, I just joined my new company 7 months ago, and I learned we can be as an investor for the ILS market, but at the same time, we can be a sponsor, something like a cat bond, and then a lot of a single risk that Mitsui & Co. invested globally. Sometimes it's a peak zone or non-peak zone that can be supported by collateralized reinsurance type, by some collateral protected, and also we can be also a sponsor of the cat bond, because within Mitsui & Co. we have our own captive insurance company as well. So I think in short, back to your great question, we are the asset owner, and also at the same time, we are the origin of the risk within the insurance value chain. I think Mitsui & Co. as a trading house, we have a very unique value proposition, because as a professional investor, there are maybe 17 core functionality of what Mitsui & Co. key focus, including healthcare and medical, and then data center in Japan. So I think all this kind of activity, because we talked about cyber, we talked about longevity, but all these kind of things, we are actually Mitsui & Co. and trading house, we are the origin of this kind of risk. When we talked about risk management, when we talked about the view of the risk, when we talked about ultimate level of the risk and retention, then everyone was busy to understand about it. But at the same time, we talked about performance. But I think the origin and ultimate purpose, we need to spend more time about the view of the risk, and who is the main investor, and who owns this kind of risk, and who initiated this kind of a huge portfolio, and what is the kind of the motivation. So in short, we are as a risk orientator, and at the same time as an investor. I think if we can spend more time to understand about this kind of a trading house business model, so in the end, ultimate purpose I learned, but at the same time, we also need to work hard for our stakeholder and invest as well. But main purpose is to make our society better throughout this kind of infrastructure development and healthcare and medical. But at the same time, we also need risk management strategy. But historically, this kind of trading house business model is not welcomed by insurer and reinsurer. Maybe result is good, and then pricing is too competitive, and then territorial scope is too wide. But from a reinsurer perspective, I understand some reinsurer, they are successfully launching new sidecar or working on new sidecar. But we can be an investor for this kind of sidecar as well. We already did some investment for sidecar. Then, as a risk originator, so we understand well about the origin of the risk, and then we are bringing our own risk, high-end risk mitigation activity and loss control activity. So in the end, this will be able to bring the good performance. So yeah, so that's why as a trading house, we have very unique value proposition as an investor and as a sponsor. So hopefully we could create a lot more opportunity within the insurance value chain. Thank you.
Sounds like your company have a quite big risk tolerance. I guess that in the sense that you are able to diversify the different type of business side, even within insurance and insurance, so you could diversify within the space so well. And perhaps that you're more using the qualitative analysis rather than quantitative. You may have a risk limit per each transaction, I'm sure.
Yeah.
But sounds like, from external party point of view, that you seem to have a, higher risk tolerance comparing to typical fixed income investors, which is a good thing. But, but I would like to go back to Leslie in a sense of from fixed income investor point of view. Do you put, how do you actually sort of report to investment committees if you see some catastrophe loss events, or if you see some mark-to-market adjustment in Q2, for example, this year? Do you communicate to IC regularly, or that's something that perhaps ILS fund manager would like to know, how to react?
Short answer is no, and because it's right now it's a relatively small part of our portfolio. But I think one of the things that coming back to the earlier point about sort of due diligence, when we think about investing in ILS, I think there are three questions that we ask ourselves in terms of whether this strategy, this asset class works for us. The first is, what does it do for our portfolio in general? The second is, can we understand the risk adequately? Are we paid enough to assume the risk that we're taking? And the third is, what is the potential for big catastrophic losses? In terms of the first, I think that's pretty straightforward. Diversification, it gives us a return characteristics that is largely uncorrelated from the rest of our book. So that is actually very valuable to us in terms of providing kind of ballast in terms of the rest of the portfolio performance. So that's an easy one. In terms of understanding the risk and making sure that that we're getting paid adequately, that was a bit of a challenge. I talked earlier about the learning curve, but ultimately two things came around that sort of made it work. One was the fact that having done a lot of work in understanding the space, realized that it's not just us as the sort of tourists in the area, but it's a functioning market with buyers and sellers who are incredibly sophisticated with better with detailed modeling experience, such that specifically for cat bonds, that there is a functioning price market. So that should be efficient, fingers crossed. So as a result, then that sort of takes care a bit of the market efficiency and making sure they were paid enough. But on top of that, at our point of entry, there was a excess spread versus the losses that you'd expect, and that gave us an added comfort in terms of the margin of safety. That's always something key for us, particularly in spaces that we're new to and that we're less experienced with. And then the last bit is with regards to catastrophic risk. Even if you're priced correctly, it's priced efficiently, there's still the chance that things could go really wrong. And if you lose money buying bonds and the market has a big downturn, that's the market. If you lose market when the market is flat, but because of some catastrophe, that's potentially a career risk. So from that perspective, that was probably one of the more challenging aspects in terms of how do we convey this. So I think what was really helpful was looking at some of the past historical events that led to big losses in the industry, things like the San Francisco earthquake in the early 1900s, Katrina, and what that impact would have been on the portfolio. And importantly, to weigh that against the remoteness of that potential of that event happening. And once you look at that, it starts to make sense. Yes, that could be a 25% drawdown, but it's going to happen once in every 200 years. Versus, 2022. Bond markets were down about 20% as well. But that seems to be happening once every 10, 20 years. So I kind of liken it to how some people are more afraid of flying than sitting in a car, where the fear is very, very visceral. But statistically, if you think about it, you're actually safer flying than sitting in a car. So in the same way, investing in bonds, in ILS and cat bonds, the risks of having egg on your face, it feels high, but when you look at it on a statistical basis, it's all right, and I think you're getting compensated enough.
You're
So-
right. Yeah, fear could be a good factor of the illiquidity. Illiquidity premium
Yeah.
for LS, and on top of illiquidity, the fear factor could be probably the uniqueness
Yes.
of this asset class versus other assets in your fixed income.
So that's my argument. I hope it sticks when the next big catastrophe happens.
Well, you're right, and also you are right about pricing of cat bonds. It's been priced well, despite all the bumps and in the last how many years, 20 years, and perhaps that other private assets may not be well marked to market. Comparing to cat bond, cat bond is actually weekly priced, and it's actually priced relatively well for the losses, and also in terms of trading, and the actual sort of the bid offer spread is actually relatively small comparing to
Right.
private equity or private debt. If you want to sell it, can you sell it at the mark? It's almost like a difficult question to
Yes.
get answered. So I think, relatively speaking, cat bond is probably the most liquid in the private asset, and most well priced and most well experienced asset class. But just going back to 17, 19, Stefan, that I guess that you're also dealing with the private side of ILS, and they have some issues relating to secondary peril, and also some of the side pocket issues. And some people in this region talking about the model versus actual losses seem to be a little bit wider than they had initially anticipated. And what do you sort of view that the current market, has it surmounted these kind of concerns? Or
Well, I'm not sure whether it has been fully addressed in terms of the structures, right, that are available, or the type of investments available. But I think definitely it has been a learning experience from the investor side, and I guess investors have adjusted to some degree their behavior. And I would say that given the appetite we have seen for cat bonds, I guess to some degree is a result of that experience as well. To go more to the more liquid side than before, probably. And those, of course, currently that's not so difficult because the cap bond returns are very attractive as well. So it will be different again, once we're in a soft market, I guess, when it's when maybe cap bonds are not that attractive, then maybe there's again people will start to look into more less liquid instruments, in order to get that return. But that's again where I said I think that's where one really has to be disciplined at that point. And yes, I mean, many investors were disappointed. That was our experience, not so much by the fact that there were these losses 17, 18, but I guess by the way the industry dealt with it. I think it's okay within the insurance industry, but of course when it comes to the investors, with the side pockets and the trapping of collateral, and I mean there's some funds that repaid the last trapped collateral from 17, 18 in 2022, right? So actually it took quite a long time, and typically I guess people expected 3 years, but then was a way more than that, and that led to some frustration, I believe, for some investors. So that's why, again, as I said earlier, one has to be really careful when you advise investors, about the risk going into less liquid instruments. I think that's the only thing you can do. Losses will happen, but I think that's the only thing that you can do to make sure investors are fully aware of that, and also what you have in your own fund, right? So that they know that there are this less liquid instrument in there. I think that's how I think this has to be addressed.
InYeong, you have something to add? The last 5 years development in this industry, I think it has challenges in the past, but we have surmounted quite a lot since then.
I think I agree with Stefan's good comment, but at the same time, Mitsui & Co. is one of the trading house. we also need to work hard for our own investor group as well. There are a lot of investment activity within the fund. This kind of financial institution is one of the core functionality, but to show the returns to our investor group as well, so we need to finalize the performance within the certain period of the time. But we have learned this kind of after post-loss settlement, it took longer than our initial anticipation understanding. I think that was one of the difficulty. And then at the same time, as I mentioned previously, so we could potentially provide additional capital for this kind of ILS asset managers or ILS fund managers. And then if this kind of the ILS, the managers can spend more time to understand about trading house business model, and then we could be, so just like as a risk originator, so if this kind of ILS market can provide some solution, either collateralized reinsurance or sidecar, and then cat bond, I think this will be another stage to bring their asset into ILS markets.
Okay, thank you. Leslie, I just want to ask you that this is maybe coming from my curiosity, but what is the best way to define the allocation of ILS? You know, what's the best way to have an optimal allocation within the fixed income asset? What's the best way of, you know, what factors do you tend to use to calculate that number?
Yeah, it's a challenging one because it's so different and it's new for us. Like I said, we look at the past returns and the volatility. It's very attractive, and it would argue for a bigger allocation. What is always at the back of my mind is that when you think about the catastrophe risk that you're looking at. A lot of these cycles are way longer than the track records of the funds, the managers that we look at. So, we don't know if we've been lucky or it's good performance or luck that we haven't been hit by a very big loss. So, from that perspective, it's going to be more caution for initially until we get more comfort, more understanding with the asset class. Yeah, I mean, I think the diversity aspect, which helps lower the overall volatility, is very valuable. I've mentioned that before. But we don't want to be too cute about it. It's new to us. We'll take one step at a time, and as we get more experience, we might, or the pricing gets more attractive, we could always move up allocations.
Well, we appreciate your real honest view on this. So thank you so much. I think the remaining time is about 6 minutes, so I would like to invite questions from the audience.
Yeah, thanks for the panel. Just a quick question, mainly to Leslie, but maybe also to Stefan. Just playing the devil's advocate here, knowing that we are at an ILS conference. At what point does the effort in trying to understand this asset class, which is, as you admitted, very complex, at what point does it outweigh the benefits or the pros of this asset class? So not just with cat bonds, nat cat related cat bonds, but also we've heard today cyber as well. So, and you did mention that you would like to understand the asset class better. And of course, you're very well served by folks like Stefan and others. But just wanted to hear it from you. Yeah,
no, I mean, that's a very, that's something that crosses my mind a lot. And, am I creating too much headache for myself by looking at something that's so wildly different and out of my personal experience as a financial investor? I think there's some degree of intellectual challenge there, but as we think about why is this asset class interesting to us, the biggest driver at the start that ultimately got us going was the fact that you're getting paid such a large excess spread. Dislocations is something that we are very clued into, and we try to find opportunities to invest, and quite frequently those are our best investments to invest when there is a shortage of capital. And that aspect is easy to understand. When that excess spread narrows and disappears, then it becomes a question of, do I stick in to this asset class? I'm not so sure. When that point comes, we might reassess and say, actually, there are better opportunities elsewhere. So that's something that we spend a lot of time doing. And in this case, it was a matter of like, statistically, we understand enough. We're getting paid a big margin of safety, so that's okay.
Well, I mean, from my experience, you know, my previous life was part of a large private bank in terms of in charge of the products and investment strategies, and in our discretionary mandates, and that's more 20 years ago when people started investing in Switzerland in private banks, we allocated between 3 and 5% to cap bond funds. So if you see how much time you spend on the other, right, as the classes you have in your portfolio, then probably that gives you a bit an idea how much, you know, time you should or could allocate on researching ILS and cap bonds. But yeah, I think that's how I would answer that.
Okay, any other questions? The two. The lady in the back.
So this question is primarily, I think, probably for Leslie, and also the gentleman, please chip in. I want to actually ask a question on the investor's view on the pricing. So when pricing attractiveness, given current rate environment, what is the spread pricing level that you would think would be attractive for you to actually look at the ILS? And then, you know, in coming out with this particular range of spread, what are the key risk factors that you actually look at? Do you actually need to look at the model, or you have your own sets of factors? Thank you.
No, I do not look at models. You know, we are fund investors, and throughout all our investments, we rely heavily on our managers to then express our views in the most attractive way possible. In terms of this trade specifically, I think it's driven a large part by what we see as technicals in the market that favor investments for now. I would say that, you know, it's a combination of things that as we think about the allocation, part of it is the outright attractiveness of the pricing, but also it's the relative opportunities that we see across our investment universe, where today things are not very attractive, so we kind of look a little bit further away. But if conditions become more attractive in the mainstream, the threshold for keeping this investment on would be higher. We're pretty opportunistic in moving in and out of opportunities.
Well, currently the capital market has been probably the highest spread in history over risk-free. So the over 9% right now, and also that's actually sort of on top of the risk-free rate. So it's in total 14-15%. That's for the weighted average spread for capital market. So I guess that this is probably the one of the factors that many investors are watching. And in terms of risk, I think the ILS managers will all share with you the 1 in 20, 1 in 50, 1 in 100, 1 in 20 number, very at risk number, as well as expected loss number. So there's so many statistics that you could actually look at when you compare the asset versus other assets. So if it's helpful.
Can I add? I think on top of pricing perspective, someone like Mitsui & Co. is a trading house. We are professional like investment company. And then if we could develop any good like a risk management strategy from any type of ILS, I think it would be efficient and great idea to develop for the collaboration.
Stefan, would you like to add?
I say, no, not much to add. I think you explained very well. I guess So yeah, obviously the ILS, the cap bonds have two components. One is the risk-free rate, and the other one is the risk premium you get. And the risk-free rate, I mean, has nothing to do directly with the ILS space. So that's either it's rather high now and could be lower. But what you really have to look at is really, and that's I think what Leslie was referring to, is how much do you get compensated for a unit of risk. And if your portfolio manager tells you the expected loss, meaning what's the real risk, and that's the right way, I guess, to look at the risk of these portfolios. How many times do you get compensated? So now today, let's assume your manager has 2% expected loss. Then if you have 5 times multiple, then you get 10% insurance premium, plus of course the risk-free rate. And so currently, obviously, as has been said, that's really high. If you look at that multiple, it's relatively high compared to the history, and that's why it's attractive. And I guess that's the best number to monitor, I think, and the easiest to monitor as an investor.
Thank you. Any other question? I saw the gentleman. White shirt. Thank you.
Just a quick one. To what extent can investors accept unmodeled perils inside their portfolio? For example, if you look at a regional Asian insurance portfolio, chances are that not 100% of that portfolio is modeled. So in your experience when talking to investors, can they accept a certain percentage of unmodeled perils inside that insurance portfolio?
I guess that's for most investors a very technical, I guess, question, to what's exactly modeled and what's not modeled, and also as we all know, I mean, the quality of the models is not equal across the globe, and I think there are some blind spots, right, and I guess not. If you look at expected loss of portfolio, probably not everything is included. Typically, it's included what actually can be measured, right? So I think that's the risk that probably needs to be taken into account, but I don't think that's a significant part of those portfolios. Typically, I think most of the perils in there are very well modeled, and as we learn now today, obviously even the cyber risk can be well modeled. So I think that's it's going in the right direction.
I think a model development is something that ILS managers spend a lot of money into, and some of the secondary peril models, even though the major catastrophe models are developing very well, the in-house model could be added. So, for example, no model risk, I think it would be a little bit challenge for ILS managers, but if managers able to create their own internal model for that could be potentially possible to invest. But it's not something that they could allocate a big amount, unfortunately. With that, I think it's the end of our session, and thank you very much for listening to our panel discussion, and thank you for all the panels, wonderful discussion today.